Hey guys, Freaky Finance here. This week we're going to do two videos because it's the Thanksgiving long weekend up here in Canada. So today is going to be a different one, and tomorrow I'm going to do a normal company. And this one is more to get my thoughts out on the current environment for the next quarter anyway, and hopefully the next year. But again, I'm going to do an annual review probably on January 1st again, like I did last year, to try to reflect on what I got right, what I got wrong again, right? And we're going to start with the topical items, which is freight and wage inflation, price inflation in general, and kind of what I've been seeing going through quite a few calls, and we're about to hit earnings season, so it's kind of what I expect to see in the next, for this Q3 reporting season, July, August, September period for most companies. Enough preamble. So this is DollarTree. They kind of talked about their freight, and DollarTree's not dumb. They do hedge out, contract out quite a bit of their carriers, and they originally thought that their carriers would only be able to fulfill 85% of their commitments to them. But it turned out that they're actually only able to fill 60 to 65%. I view this one, some people have there's this inflation transitory versus trending kind of back and forth out there right now. And I view it more nuance as both, right? There'll be some things that are more peaking and some things that are more structural. So what I mean by that is I don't expect 400% freight increases for the rest of DollarTree's operations. Right, and I don't own DollarTree, but they had really good slides on freight, and they kind of broke it down like why we're more sensitive than others, right? They have Walmart down here. They have themselves being about 4x more expensive, or 4x the impact rather than a Walmart. And so it is going to impact all these companies that ship from China to North America. We had a lot of exposure there anyway, and you're going to see that in the numbers. So yeah, this is the current company outlook. Basically, they guided down, and you can see diluted EPS is now only $5.40 versus $5.60, marked down $1.50 to $1.60 due to freight cost, which is pretty crazy, right? That means this company would have been able to generate probably $6.90, right? $7.20, which makes a huge difference on when you're getting a multiple of $20, right? Because you go 20 times this, looking at an extra $20 up in the stock, right? And I think the market's trying to figure out what this means in the long run. And I actually view this as not likely to stick. So I mean, next year when I'm looking at Q3 or Q2 for DollarTree, I'm going to be like, okay, well, probably both quarters. I'm going to be like, wow, the company looks way better in cost because this year is an outlier. That's what I'm hoping. The market originally punished these guys very hard. Thought about buying it. I kind of wish I did. When you look at the chart here, let's do this first. You can see the news when they had to write down their guidance got smacked pretty hard, going from $106 stock to a $90 stock, and it got weaker and weaker. Actually hit $85, which is pretty crazy, right? Like I said, they're almost still doing $6 in earnings despite the freight. We know the company can probably do over $7.50, probably fairly easy in a normal environment. Then you see it shoot up. And one of the reasons why is that they finally decided that they're not going to stick to their dollar. A DollarTree is a dollar store, right? A dollar price point. And what they decided is that they're going to pass on the inflation to the customer. Now, this was always a trend that was going to happen, in my view, but now it happened. And now the stock is back up to around 100. So the market's trying to get this right. And what I think, the reason why I do a DollarTree as an example is because it also brings into which companies can increase prices and push the increase that they're seeing in their supply chain onto the end consumer, aka you and me. DollarTree is an easy example of that because they've kind of held themselves back on the price sensitivity side. Like, are a lot of people going to care if their $1 thing becomes a $2 thing? Maybe, maybe not. For certain items, probably. For other items, no, because it's still probably cheaper than anywhere else. Especially, and is that person still sensitive if they just got a 5% wage increase, right? Again, breaking the dollar here for a DollarTree is going to be very big. So what I'm hoping is the next quarter is bad as well for freight costs. Things spikes down again. I now know with certainty that they are breaking the book, and then I'll buy. That's kind of my angle on DollarTree. Kind of sucks because I was like, oh, I should have bought it. But you never really know how these things work. And there is still a lot of uncertainty. Maybe I'm wrong with freight, right? Maybe it sticks higher for longer, but I think it's 500% increases are usually not sustainable. And here's they kind of talk about, and combined with our low $1 price point, we have an outsized impact from freight costs. So that's what they're trying to say. And that's what this slide hopefully showed, is that one of the reasons why they're so sensitive to freight is because they have that $1 price point. And if I read between the lines on this conference call, I should have realized that they were going to increase the price point. That's kind of what the sentence says, right? But anyway, this is when they say, hey, we actually had our freight carriers say they could take 85% of our orders, but really they can only do 60 to 65. I thought that was interesting. But the most interesting part on this call was right here. And he talks about a certain example, and the CEO is very candid. I kind of like the call. He's like, to give you a life example, one of our dedicated charters, we were denied entry to China because a crew member tested positive for COVID. They're denied entry to China, forced the vessel to return to Indonesia, changed the entire crew before continuing on their voyage. So that one voyage was delayed by 2 months. So 60 days. That's pretty crazy, right? And this is what I've been hearing from quite a few calls now, is that basically your days in transit have gone from, say, they basically doubled. So it was 35 days, now it's 70 days. And that's not just DollarTree, that's a couple other companies that I follow. I think Nike said the same thing, Colaris said the same thing. Basically, people that make goods and you're at Asia Pacific and have to ship it to America, it's taking about double the time. And so one of the things that I like to look at is, okay, so if shipping cost is high, that means the shippers are making money. So then you go to the containers, right? Here's Maersk. You can see longer term, not a very sexy chart, but during this is the COVID panic down here, and you can see the market got this right. And the earnings for this company have been very good. But now the market's wrestling with, okay, are we at peak shipping? And that's what this is going to hopefully tell me going forward. Yeah, we probably are. So hopefully, well, not hopefully, if you're a shareholder of this guy, maybe you sell. But I missed this move in shipping. And so what I'm going to use this as a bellwether for shipping rates in general over time, because the market will try to front run it, right? Hopefully this starts declining back to no more normalized level, and that will also tell me that freight in general is being alleviated for all these companies, because freight costs impact so many companies. But right now, this company's making a killing. But again, that's backward looking because shipping rates have been so high. You're going to get news flows for everything. This is news flows saying they think it's going to be elevated into 2022. Maybe they're right. I kind of view it as we're kind of at the peak right now. Another thing that's happening is, so like Fred, very good and informative. But anyway, you can see the spike in trucking as well. So not only are you getting hit on the ocean freight, you're getting hit on the trucking freight. And this is more interesting because I can't just be like, okay, like that one example with China making the trip 60 days longer and making the whole cruise ship change up because one of the crew members was infected with COVID. You can see, can't explain that with trucking, right? So this is really a good story, I think. And it could be connected to freight as well in the ocean, right? If there's a bottleneck there, does it make a bottleneck here? But regardless, it should just tell with us that truckers are scarce. If you have an 18-year-old at home, I want to think about making them go in trucking for a year. I don't know. But they're probably going to start being able to pull some wage increases here. Nike's quarter was interesting. I wanted to bring this up because Nike's a really big company, right? Big retailer, big brand. And you can see the right here, overheads up 15%, primarily due to wage-related expenses. Again, so we're starting to see labor, and that's why I want to break out which things are likely going to be sticky, which things, like I said, are more peak transitory, like, say, what my view is shipping. So this one, labor is sticky, right? Whenever you give someone a raise, they're going to expect to be paid that amount next year, and slightly more the year after that, and slightly more the year after that, probably, right? Anyway, when they're re-rating higher on labor because they're rehiring people and people are making themselves scarce, you're going to see wage increases. And that's the harder thing for me as an investor. I'm like, okay, which companies can pass this on to the end consumer, right? So I have to start thinking, okay, well, large tech companies probably would be able to, mainly because they don't have that many employees, right? So now I want to look at people that have lower amount of employees per dollar generated, which is a thing I'm not used to having to think about. That will be something I think going forward I'm going to be more sensitive to, and when I'm going to start trying to filter in more companies, it's what I'm going to try to be angled to. The trick with this then is a lot of the companies that don't have a lot of employees have already been doing well because COVID was good for technology companies, right? We're all working from home. So it's kind of funny in that regard. It's going to be harder to find companies that don't have that much labor input costs that aren't already at high valuations because of the COVID effect that we're coming out of, or in my view, coming out of. But I could have said that 6 months ago before Delta really hit us, right? Here you have the gross margin effect on freight, so Nike also flags their freight cost. Here you can see the effect just on the 3-month income statement. See the percent of revenues for SGA. It's now at 29% versus 28%, so you're seeing negative scale. But yet you're seeing margin expansion. So Nike looks on the surface here to be able to push their increases that they're having in labor into prices that me and you would pay for their products. That's what this would tell me, but it's too early for me to really say that. But yeah, it looks like at the very least they price out their freight into their end price users. Overall, you can see the company's still doing good, but it's not doing as good as what the market hoped, and it sold off on this news despite a decent quarter, mainly because of guidance. They basically said that, well, here's kind of, this is from the call transcript right here. So 80% of our footwear factories located in the south, and nearly half of our apparel factories in Vietnam are closed. So yeah, so they have a lot of exposure to Vietnam. So one of the things that I started looking at is the Vietnam cases, and yeah, they're going down with the rest of the world. At the time of this conference call, Nike reported a couple weeks ago, maybe more than that, maybe a month now. But you can see Vietnam is actually going down now with most of the world. We're seeing a 7% decrease week over week for quite some time now, which is interesting. As the reflation, a lot of the things that I'm long on the reflation side haven't even come back to where they were before Delta variant. And these companies are, well, the companies I'm in actually cut quite a bit of cost during COVID year. We're going to start seeing some real torque, I think, as the world actually believes in their recovery. Because right now, it feels like they don't trust it. And I'm like, well, how long do you think pandemics normally last for, right? But anyway, I thought this was interesting. For Nike, the labor inflation is probably sticky, but the bottleneck on their inventory guidance is probably transitory, right? Vietnam's going to open back up. They already have, right? We're now in October, and we see the cases keep going back down. So this should alleviate itself. But they did say, literally, they basically said that they have the demand, but they can't sell the shoes that they don't have. so that's really why they had their guy down the guidance. So it's going to be a very interesting time, because I don't know how the market, because I'm not used to seeing this, I don't know how the market's going to react to this, right? So they already got it down. When they show their poor numbers, right, because they didn't get the inventory they wanted, they're going to sell the inventory in hand. They're not going to have any promotions, so that's going to be good from a margin point of view. But on the actual sales number, it'll be interesting to see how the market responds to that, right? They've already guided to it, so it should already be priced in, but I don't know that. So that's kind of fun for me. So I'm going to be paying attention to Nike's call. And yeah, here's them just marking down the guidance. We expect fiscal 2022 revenue to grow mid-single digits versus the prior year, versus our prior guidance of low double-digit growth, due solely on supply chain impacts that I just described, aka their Vietnam and Indonesia, were required to cease operations in the first quarter. First quarter for Nike is different than calendar. You can see, therefore, revising a short-term outlook to incorporate 10 weeks of production lost to Vietnam since mid-July, and factory opening to occur in phases beginning in October. I'm pretty sure these things already started up. Anyway, General Mills is another interesting one. This one's more recent. See, input cost inflation, now 8%. Originally they had it at 7. Before that, I think they had it at 5. And they flag labor as the main reason. So what they're going to do, well, they already had a plan in place to reduce their COGS by about 4%. So about half the inflation increase they can save just in their cost-cutting strategy. So basically they're saying they don't have to push only half the price increase to the end consumer. They also highlighted their SRM actions. And really that's just promoting the right products, probably localized pricing, going up the sales mix, so trying to attract customers to the higher sales mix item to protect margin. Ultimately, you can see quite a bit of pressure here. We'll have to see if they actually are able to do that. But I did like how they had a plan of action there. So yeah, General Mills is pretty interesting. I guess I should have just shown you the brand. I'm kind of always assuming people know a little bit of the company. So General Mills, your cereal. They did buy Blue Buffalo, which is good for pets. Yoplait, Old El Paso. So anyway, they also do have a pretty big baking business. So when the world shut down and people are eating at home more instead of going to restaurants, these companies actually perform very well. Again, I think that's transitory, but they think they'll be able to convert some people that learned how to bake to stay baking after COVID, as their angle as management of a company that benefits from that. But anyway, one of the things that's interesting, like I said, so they're expecting 8% inflation. They think their cost of goods sold, they can get it down by about 4%, so they won't have to increase their prices by the full amount of inflation. That's kind of what that tells me. And here they said the second thing is clear is that we've done a really nice job with pricing so far. So our prices are going to go up for the remainder of the year as we see inflation going up. So you're going to start seeing prices increase on your Cheerios, right? That's what that tells me. So again, they're going to pass through some of the prices to the end consumer. And the thing that's interesting, because it's macro inflation, that's hopefully what this is showing you, because I'm jumping through different industries, is that it should be a macro event, so all the companies should be experiencing the same thing. So even the retailers, so say like if you go to Walmart and buy Cheerios, General Mills product, Walmart also has a private retailer that's competing with Cheerios, right? They're going to have some great value product or something, right? And so Walmart's private retailer is also going to start feeling this pressure at prices. So we'll have to see. It's interesting though, right? Because the private label should likely may not, I'm not sure if this is true, but this is what I'm thinking, may not have the power and the scale that, say, General Mills has to increase prices, or it might have to increase prices more because it doesn't have the same scale. And the thing is, when you're a private label and your whole purpose is to get the cheapest price possible, the people that buy your product are likely to be more price sensitive. Whereas the people that were already buying Cheerios were already paying more than whatever private label was on the shelf. So it might be interesting to see the market share if it, because over time private labels have kept taking share from these big brands. And it might be interesting to see if that reverses for this year anyway. That's something I'm going to probably pay attention to. But just random aside. But anyway, inflation. For example, Pepsi also reported last week. You guys are familiar with them. Quaker, Doritos. On the food side, Ruffles, Tostitos. Beverages, obviously, Pepsi. And all the Pepsi brands. Pepsi was interesting. So General Mills actually didn't increase their guidance for revenue, which is interesting because they're increasing prices. Part of that is because they are expecting some of the COVID sales that they got to go back down, actually have a negative year-over-year sales growth guidance. But anyway, for Pepsi, they're growing pretty crazily for a consumer staple. And maybe that explains why the PE on Pepsi is still very high, over 25 for us. I can view it as a consumer staples, right? But yeah, they're growing 11% this year. Again, part of that's pricing. Here, I thought this was interesting. Pepsi, we forward 6 to 9 months out. Those hedges that we had at the beginning of this year are going to start rolling off. The new ones that are in place are going to have the higher cost. So it's basically they're saying they're going to see inflation on a leg because they forwarded out. And General Mills, I liked how they had like a little plan for inflation. Pepsi didn't have a slide dedicated to it, but this was interesting on the call anyway. They expect to be able to pass through the inflation that they're facing, whether on the raw goods or on the operating, aka the wage inflation. They're just going to use pricing for that. So they think their brands have enough power that they're going to be able to push through on pricing alone. That'll be interesting to see, that strategy. Some of the pricing already occurred in the summer, more is likely to occur in the fall in the beverage business. And substantially, all of it for 2021 in the snack food business is occurring as we speak. So your Doritos are going up right now. It's pretty interesting, right? Because this call is more recent. I think it was just last week. Interesting times. And yeah, here's the Pepsi again. They expect to deliver approximately 8% organic revenue versus those 6% they originally forecast. So when inflation happens, if they're trying to pass through for pricing, their revenue should increase and their margins should stay flat. That's kind of a strategy. That's what this tells me. So Pepsi believes what it's saying. They believe they're going to be able to price through the inflation to the end customer. Kellogg, so this is just a recent one. They went on strike. So again, I'm just trying to visualize that wage inflation is sticky. The people are going to get paid more, right? And so you have to visualize which people are going to get squeezed out, which businesses go under. Like, okay, I will pay you more, and then we're going to go bankrupt in 3 years, and which ones won't. So it's kind of the point of this whole video, because I don't know yet. I'm trying to find ones, and that's kind of where my head's starting to go. Luckily, we're long the energy plays, which have done well this year, and that was more of a reflation play. Now we're starting to see inflation that I wasn't really expecting. I wasn't expecting to see this huge wage inflation, and at least last year I wouldn't have thought of it as a meaningful effect anyway, but now it's starting to show itself. So one of the things that's nice is that, like I said, we have these energy plays. If you want, you can freeze these ones, but these are ones that I've kind of touched on over time. I'm going to do a video on Pay2 tomorrow on the nat gas side, just to talk about it. Now I find myself in a position because energy has outperformed my other holdings, especially, say, the cannabis holdings that I've had for 2021. And so now I find my portfolio is kind of overweight, like 17.5% energy. And I have this thing in my head, well, should I start buying some companies that can pass through inflation or don't have any wage inflation because they have very little employees per dollar generated in revenue? That's what I'm kind of thinking right now. So I just wanted to show this, and because I'm going to do Pay2 tomorrow, I'm probably going to show this slide again. Really, it's just showing how I'm thinking right now at this point of time, because I go back to these videos too, right, and try to think, okay, what am I getting right, what am I getting wrong? All right, let's go back to the slides. Kind of rambling a bit this video, but so anyway, here I was trying to show this is StatCan CapEx, so CapEx in Canada for oil and gas companies, and you can see the investments pretty much start slowing down in 2019. And then as soon as COVID hit, we're not talking about a slowdown anymore, we're talking about a 60% drop. And importantly, it started to come back, right? But not enough. And so 5.6 is a lot less than 8.2, is a lot less than 9.7, right? And what this is telling me is people, and what we saw on the, like when we go through Suncors and Vermilions, Tourmalines, all these companies, none of them, well, I shouldn't say none of them, but a lot of them haven't put the same amount of CapEx to work. They've decided to use the cash flow to pay down debt because they got hit so hard during COVID. and we're pretty much left for dead for financing. Banks were like, oh, you want to finance this? Well, we're going to charge you a retarded amount. And so what's happening is these companies are like, all right, if we're going to be treated like that, we're going to fix up the balance sheet so we can actually get some debt at decent rates. So we'll see what happens. But I think CapEx will slowly creep back up. But you can see right here that this is more structural. I'm hoping it's cyclical from COVID. But if this actually stays low, like this just underinvestment in CapEx, this is going to be really strong for pricing, for commodity prices in general. And so when people ask, well, what do you think of nat gas prices here, and oil gas prices, right? Like at 80 WTI, and the forward curve is still pricing back to normalcy around 60, 65, right? I say I wouldn't expect it to snap back that quickly, mainly because no one is investing in the industry. And if you don't have the production, then how are you going to get the prices back down? So that's what I'm thinking. That's what I wanted to show here on the StatsCan website. So this one's interesting. So we have this is just the forward curve, and I'm showing you like the current prices and then what's priced into the forward curve. So basically they're saying the prices are going to be high during winter, and then we're going to go back down to a fair level for the rest of 22. This is the forward curve. And you can see Henry Hub. So in North America, barely moved, but in Asia and Europe, it's still materially higher. So basically the market's saying the baseline is going to be higher as we come out, which is what I agree with. But on the Henry Hub side, you got to see how similar these were. The market's saying we're not going to have the same pressures in North America than what Europe is facing. And I'm not sure I agree with that. And I also not sure if I agree with this new level. Unless this price signal put a lot of CapEx to work right now as the video is coming out. Anyway, regardless, these companies on the European side are going to make a killing hedging out this. Literally, your prices went up 3x your revenue in terms of commodity prices, if this forward curve is true. Right now, it's even more than that because the spot prices are so high. But you got to look at the whole curve, right? But that was interesting. And you can see the price. So the red is the current year inventory, and the range is just in gray. And you can see our inventory in North America starting to go down relative to the 5-year. This is just underground storage. Europeans already outside the outlier for 5-year. And Japan and Korea are also just getting back into the 5-year. So basically all this shows is that inventory is lower going into winter than you'd want, which could lead to spikes in gases. But again, that's not the call here with nat gas or for energy. It's just we were already kind of in a lower investment cycle going into COVID in 2019. And COVID hit and all the capital stopped going to energy companies. And I think that it's starting to come back, but it's like, as you saw in that StatCan, it's still 40% down from what it was. But yeah, that's kind of it on inflation today. I'll do a real video tomorrow. I'll probably do like a forward-looking thoughts kind of on what I'm seeing for opportunities. Like right now, obviously, I'm still looking at China. But yeah, small caps look really good. They got hit real hard during this Delta wave. Though again, a part of that might be maybe the market thinks that the inflation, the small businesses won't be able to pass on prices, right? Something I'm wrestling with. But yeah, they look really cheap. And the reopening got hit with Delta. They look very cheap. And China looks very cheap. Canada looks very cheap. Energy still looks cheap even though they're up so much, if you look at a chart. But yeah, it's crazy right now. Lots of stuff going on. Anyway, have a great rest of your long weekend. I'll probably do another video tomorrow morning, and it will be on a nat gas play finally. All right, have a great rest of your weekend.